Broadcast is now starting. All attendees are in listen-only mode.
Hello, everybody, and welcome to the Texas Mortgage Bankers Association's 2022-2023 Education Webinar Series, which is a part of the Education and Endowment Committee led this year by Pam Jenkins and Dave Toggenbaugh. I'm Scott Henley, and I'll be moderating today's webinar. I'm a divisional manager with Certainty Home Lending in Dallas and also serve as on the board of directors of the TMBA. This webinar should take about an hour, but feel free to ask questions throughout the webinar using the chat window. And as always, if you have any additional questions, you can email Carol at the email address on the slide. Joining us today are two economists to walk us through this market that we're experiencing right now. One is Hamilton Fout, the other is Daniel Oney. Hamilton Fout is the Vice President of Economic and Strategic Research at Fannie Mae. He is responsible for providing the forecasts of loan volumes and profiles to various business units of Fannie Mae. He is an important part of information regarding regional housing risks, the transmission of macro developments through the mortgage market, stress testing, and issues related to mortgage risks and cash flows. Prior to joining the Economic and Strategic Research Group, Fout worked in the underwriting and pricing division of Fannie Mae, focusing on issues related to credit risk. In this role, he had primary responsibility for tracking and reporting on regional risks within Fannie Mae's credit portfolio, developing property level and loan level risk models, and monitoring and evaluating portfolio level risks and opportunities for the company's single family book of business. Fout received a PhD in economics from the University of North Carolina and a BS in economics and business from Florida State University. Daniel Oney is the research director at the Texas Real Estate Research Center at Texas A&M University, GIGM. Daniel is an applied economist with over 25 years of experience in real estate development, labor, and public finance. His focus at the center is developing an analytical and forecasting framework for Texas commercial markets. Prior to joining the center, he was managing director with Newmark's Global Corporate Services team, where he led the labor analytics effort. Daniel has a PhD and MPA degrees from the University of Texas at Dallas and a BA from Austin College. We'll hear from both panelists as they present some valuable information on the following slides. Hamilton will lead us off. Let's get started.
Awesome. Thank you, Scott. Glad to be with you guys today. We can jump forward here to this first slide of content. So we can go maybe two more slides forward. Yeah, so as Scott mentioned, I want to frame up a little bit what we're seeing broadly in the macro and housing markets. I think by way of just a little further introduction, I work for the chief economist. As a group, we put out a macro and housing forecast each month. There's no telling what kind of forecast we have as we're coming to present. Sometimes it could be pretty stale. As luck would have it, we actually just put out our forecast on Monday. So I'll talk a little bit about what we were seeing there, kind of what we were thinking. You guys know the kind of pace of change that we're seeing with rates, particularly mortgage rates, sometimes can make those views somewhat dated, and I'll talk a little bit about that. You know, if folks were watching the mortgage rate that was just released by Freddie, that's above 7.6 now, so we saw 7.63%. I'll talk a little bit about what that means. But let me start there with the rate. So when you guys see that 7.57 on the slide, that was from last week, right? So we're still even up from that. If we're thinking about mortgage rates, I know that's something that we want to talk about today. Happy to answer questions on this too. But when we're thinking about kind of the primary driver of mortgage rates and long-term rates, you know, of course, it starts with the inflation that we've seen here on the left. Inflation peaked at 9% or so year over year. That was last year. We look at what has kind of come in the door around the core CPI metric, the headline CPI metric. Those numbers are still well above the Fed 2% target. And I think importantly, when we look at what's happening in labor markets, those have been pretty strong, right? When we look at what happened in the September job number that was released earlier this month, saw 336,000 jobs created. That's a lot of jobs. You can look at the table we're showing here. Typically, we're looking, you know, in the 2016 to 2019 period of about 180,000. So this is a lot. You know, there's a lot of pressure kind of being put on the economy. Wage growth has slowed, but it's still pretty strong, somewhere in the neighborhood of 5%. So upward pressure generally on inflation, upward pressure on rates. And I think that's kind of the world we're living in. When you look on the right-hand side chart, then just note, you know, we can go back to the days of the pandemic and say, hey, I remember when, you know, the mortgage rate was below 3%. I mean, that was not long ago. That was 3 or so years ago. I remember when the 10-year treasury there in the blue, which is a key benchmark rate for us in terms of the mortgage space, when that was below 1%, right? And again, not too long ago, we have really been on a tear, I think, since about the end of 21, again, as inflation was kind of coming in. And really importantly, this year, when you look at where rates were to end last year, we saw rates for the first time go above 7%. They came down a little bit to start this year, but just note, we've been above 7% now 6 or 7 weeks running. So when I look at this chart, and I think this will help us understand what's going on with housing markets and mortgage markets. If we were in the pre-pandemic period, so if you look at 2019 and you say, okay, 10-year treasury, even at that peak, let's just look at that peak point kind of to end 19 when rate, or to end 18 when rates kind of picked up, 10-year was at 3%. And usually the spread we had in mind to get to the mortgage rate was around 2 percentage points or 200 basis points. So we were looking at mortgage rates of 5%. That's been the rule of thumb. You know, if you have a 10-year treasury, add 2 percentage points, you get the mortgage rate. That is not the world we live in. That spread is much closer to 300 basis points or 3 percentage points. You guys can see that. So that spread is widened. The other thing that sometimes the eye glosses over, but should really focus on, the blue rate is the 10-year treasury rate. The gold rate is the 2-year treasury rate. Usually we would expect in normal times the 10-year rate to be well above the 2-year rate. That hasn't happened. Again, a classic signal at yield curve inversion of recession. So clicking forward here. So let me talk a little bit, you know, these slides I'll make available for folks. And there's a lot of information here, but one of the things that, you know, I'll kind of touch on here, and happy to answer questions if there are. How do we think about the mortgage rate having risen so much higher than the treasury? And I think one way you can think about it, and I'll start with that right-hand chart, a lot to kind of dissect here, but you know, you go from the 10-year treasury and you say, okay, well, what are we giving, you know, if we're thinking about a mortgage and we're originating a mortgage at a rate, what part of that rate is going to the MBS investor? So that difference between the MBS rate and the 10-year rate is what we call the secondary spread. That has widened out tremendously. So as the 10 years risen, the rate that is going to the MBS investor has gone up much higher. Couple things just very quickly to think about there. One is that the Fed was a buyer of mortgage-backed securities, right? And particularly in the pandemic period, they were providing liquidity, trying to ease that market. That's what you see there in the gold in the background. They now have been running off their portfolio. So they're not actively selling the stuff, but, and as we know, there's not a lot of prepay, but still, you know, these guys releasing that supply instead of buying it has put upward pressure on the rate. I think the other thing that's missed, and this is very important, what really is probably driving a lot of this is volatility. So MBS investors do not like volatility. The red line you guys see on the right is a measure of volatility. Typically what happens with MBS investors, they don't want interest rates to rise because it means the thing that they're holding now has a lower rate relative to the market. But they certainly don't want interest rates to fall because then they face prepay. So in general, there is a volatility metric that is driving the spread. So that's one of the real key reasons why mortgage rates remain so elevated relative to the treasury. On the left side, you know, once you go to the MBS rate to the primary rate, so that the actual mortgage rate, what folks call the primary secondary spread, that really traditionally has been about capacity, right? And so when you look at those blue and you see a lot of origination volume, usually what happens when you're in a hot market like we were in the pandemic, those spreads widen. You would expect them to come in a bit when we're in a cold market like we currently are. But I think one of the things that's limiting that is the profit potential in the market, right? I'm showing that a little bit in that table, that it is difficult to make a return on a loan given how small volumes are. That's kind of kept spreads wide. So I think those are kind of two key drivers. Let me talk a little bit on the next slide, and this will be the final slide that I kind of talk to help frame up what's going on in the housing market. Once you have the mortgage rate and you know it's very high, and you know, how high is the mortgage rate? What does it actually mean for buyers? Let me turn attention to that chart on the right-hand side. You know, you got to combine not only the mortgage rate going from below 3% all the way up to, like I said, 7.63 today. You also have to combine that with this idea that home prices from the end of 2019 now to our most recent read, we actually just released our data on 2023 Q3 earlier this week. Home prices are up roughly 50% over that period. And that blue line there on the right, this is the fraction of income if I'm a home buyer and I want to go into the market and try to buy. This is the fraction of income that I need to pay to make that mortgage and interest payment. In normal times, and I don't know if you can call the 2016 to 2018, 2019 period normal, that was closer to 20%, right? 20 to 25%. We have blown through that. right? And you can see the straight kind of climb that we've been on because of the rate increases. That's now closer to a third of income. So that's put a lot of pressure on the home buyer. And as a result, when we were looking at this, we were kind of thinking, well, you know, we should see some home price declines. On the left-hand chart, you see this, right? We definitely saw some home price declines in Q3 and Q4 of last year. That was the moment when rates really moved up pretty dramatically to that 7% mark. And you had folks who had properties listed for sale who ultimately ended up transacting at a price probably lower than they listed. But that has not been the experience that we've been in the last 3 quarters. I think folks have adjusted to the higher rate. I think it's an open question about how people are going to perceive a 7.5 and a 7.6 that are coming through the door. But largely, we've seen it isn't, affordability matters, and it is limiting the choices of home buyers. But what really is driving the day, you can see this on the right there in the that kind of light colored yellow, that's the supply. That's the inventory that's out there available for sale. There is not a lot. Supply right now is in a competition with affordability to see who can win in terms of home prices. And right now it really is supply that's kind of winning that day. And as a result, you guys can see on the left, the more recent orange bars have been positive. That 1.7 is the one we put out earlier this month, or earlier this week. And when we look at our outlook, then we kind of still see that home prices are going to be pretty positive. We got a 6.7 for this year for the 23 annual number and around 3% for next year. So we can transition. I'll just land on this slide, the next slide. Like I said, we put out our forecast to the public, a 2-year forecast on a variety of items. So housing, GDP, some other items. We do mortgage origination. So we can make these slides available so folks can kind of review this as posted on the website. So that concludes my remarks. And Daniel, I'll turn it over to you to talk broadly Texas economy and Texas real estate outlook.
Okay, thanks, Hamilton. So as soon as I get control of the screen. So one of the things that maybe it's a little spooky, but I've been on panels with economists from the Fed, Fannie Mae, local research centers, and there's a scary amount of agreement. So I don't know if that's a good thing or a bad thing when you have that many economists who are tending to agree with each other on the outlook of the economy. So the national picture certainly influences local markets, but one of the things about economics, right, is that people, money and talent seeks opportunity. And so there may be differences in opportunity and return across assets, or it could be spatial. So we can look at the Texas economy and see a lot of different fundamentals from what you have at the national level. So I've got a little content here just about the Real Estate Research Center. I'm going to skip over that, but I will call your attention to our website. So everything we publish is freely available to the public. You'll get this deck after the webinar, but take advantage of some of those resources. So from a macro perspective, a lot of market fundamentals are relatively strong compared to where they've been recently. In Texas is really outpacing the nation in terms of economic output that we measure with GDP and in employment. So from the output standpoint, last 5 years, Texas has grown about 0.7% faster than the U.S. But in the last year, we have had a big jump in that, where Texas is now doubling the U.S. This is still old numbers. To get at the state data, you're looking earlier in 2023. But that GDP growth is not even across every industry. If you think about our GDP as like your average grade in a class, we've got some Fs, and we're trying to make up for those Fs with some A's and some other assignments. So things like mining, construction, natural resources, which used to be Texas's hallmark economically, are not performing well. They're actually a drain on our economy because they're contracting. But it's the finance, real estate, professional services, information, the service sector that's really adding growth to our economy. And even compared to the nation, if you subtract Texas's growth rate from the nation, we're underperforming on those real sectors. That means U.S. agriculture, mining, construction, health and social on this chart growing faster than Texas, but we're outgrowing the nation again in those service jobs. When you look at in output. When you look at jobs, Texas job growth is way faster than our economic output growth. Our jobs have been double the U.S. rate over the last several years. And as a commercial focused guy, I like to look at how employment is doing in the different industries that use different types of commercial real estate. And we're seeing strong employment growth across the sectors that use industrial, office, and retail in Texas. So that's a good sign. But some of these things, like on office, that office job growth, if you have companies that have remote work policies, job growth there is just like pushing on a string. So it's not really doing a lot to buoy, office rents and net absorption. This is probably the most important slide in the whole deck. Texas's population growth has been so robust for so long, it really acts as a floor under our real estate markets. 30 million people in Texas today, 2,000 new Texans every day from all sources of increase, moving here from other countries, from other states, and then net natural increase in our existing residents. So if those trends persist, you should always expect Texas to perform a little bit better than the country. This is a closer look at some of the immigration data. So net migration internationally and domestic is at a record high last year after being down a little bit. And then Texas's contribution to the nation has been increasing. If you look at the blue bars here, you can see what the total contribution to U.S. growth has been since 1970 for Texas and our big markets. Over that 50 years, Texas accounted for 15% of the nation's growth. But since 2010, the orange bars, Texas is accounting for 20% of national growth. And you've seen that same acceleration across all of these markets. Now within Texas, a similar story is holding. Our big metro areas are accounting for more and more of our population growth. And even though we have 25 metropolitan areas in Texas, most of those metropolitan areas are only growing a little bit, and some of them are flat. And we have 254 counties in Texas. More than a third of those counties are losing population. So we know this robust growth is not spread around equally. So turning to the Texas housing market, we're showing some similar signs to what you saw in the nation. We're definitely off the peak home sales statewide. For Texas, that was in December of 2020. We're down right now 15% from that peak. So from 35 to about 30,000 sales per month. If you want to look at it before and after COVID, this is another way of breaking the data out. So this is the state sales each month. The blue line represents the average the 3 years before COVID. The yellow line represents the average the 3 years after COVID, which was much higher. We see that boost from migration, from cheaper money through Fed stimulus and through federal fiscal policy that put a lot of people into the housing market. And now the orange line, that's the 2023. We were tracking with historic trends for the first half of the year, but we've definitely seen a pullback over the summer. And this is my call right now in terms of a tracking forecast. So these are statewide sales in thousands, where you see the peak in 2021 is at over 400,000. Right now we're trending to hit about where we were in 2017 or 2018. And this tracking forecast has actually been falling for a few months. If we continue to see some increases in sales like we've seen lately, we may end up at the end of the year a little bit better than I'm showing right now. One of the big issues, and Hamilton mentioned it, is new listings. Now statewide, we actually have seen new listings increase. If you look at the right-hand chart, that's the year-over-year change. We're up above that little green glowing line now at the far right. It means we're seeing an increase in listings compared to where we were. There were a lot of homes that were being withheld from the market. And this differs from place to place in Texas. So I just did a presentation, some comments about the Austin market. They were a lot hotter. They went up higher. They fell further. And they're seeing a lot more withholding of inventory from the market than the state is overall. Whereas Houston, Dallas, San Antonio look a little bit more like this picture. We've seen a bit of a price recovery, which I think is showing up in that Fannie Mae forecast that you saw. For the state, we basically dipped a little bit over the last year or so. And depending on how you smooth the data, I'm showing this about where we were a year and a half ago. And then why are people moving here? Why is Texas still so attractive? You know, it's the relative performance. So if you look at home affordability, I like to use this rule of thumb You divide the median home price by the median household income. And at one time, we used to say that if that number was 3, if your home was 3 times your income, it was affordable. Well, you can see these numbers here. There's not a city that I've picked that's at a 3. And all of the Texas markets are a little above 5 or just below 5. So we're still competitive compared to some of the big coastal cities. But now Texas has lost its housing affordability edge over some places in the Southeast and the Midwest, where we used to be cheaper. Now Atlanta and Chicago have more affordable homes relative to their incomes than our big cities. And then the last housing slide, I like to look at economic history. So from 1970 to 1999, we spent about 4.6% of our GDP nationally on building homes. We had the run-up in the housing bubble before the financial crisis. And since then, from 2008 through 2022, we're only spending about 3.5%. Well, you said that's only 1% of GDP. That doesn't sound like very much, but depending on how much you pay to build a home, that's 500,000 homes a year. That's the equivalent investment that's no longer gone into housing in the last 15 years. So we've spent money on other things. It's been reallocated to other consumer choices and other investment choices. But it's no wonder we have a structural housing problem when the economy's seen this kind of shift. I've got some slides in here on capital and commercial markets. I'm going to skip over those in the essence of time and just jump to my outlook. So my outlook going forward is things are about as good as they're going to get for the next 18 months. GDP and spending will be below normal. Job market will soften a little bit, but I think not a whole lot. I'm calling for Texas population to ease some, but continue to grow. And I used to be pretty worried about the commercial real estate roll risk as more owners were having to refinance. The evidence so far is that the guys that have gotten into trouble have been those that bought at the peak. They didn't know how to manage the asset. So I'm still hoping that impact will be localized to certain markets and certain properties. Single family, again, we're seeing a little bit of a construction boost in some Texas markets, but sales are going to continue to tight the rate lock. So many people are at a better position, right, in terms of their mortgage rates. Affordability is going to keep being a challenge. I'm not real bullish on multifamily. We're still seeing permits on multifamilies fall in a lot of Texas markets. So you have builder sentiment, you have financing costs, and you have just slowing deliveries. So affordability in multifamily, I think, will continue to be an issue. And then the commercial markets will do different things. You're going to see some segmentation in office. Industrial, we've stopped building spec industrial buildings even in Texas, but there's still a lot of demand, so rents are going to be high. And then in retail, I'm pretty bullish about that because we're only building retail in the new markets where we're adding subdivisions and people, and we're repositioning retail in the older markets. A lot of downside risks, war and peace. I think the Fed's going to go higher longer, and political fiscal issues at the national level. If we can't agree on certain policies, that's going to be a net drag on the economy. So that's what I wanted to prepare, and then I'm happy to start addressing some of the more detailed questions.
Great, thank you both very much. We're going to ask a few questions now to both the panelists, and as a reminder, if any of you in the audience have anything you'd like to ask, please include it in the chat. But we'll go back to Hamilton. Hamilton, given the recent economic forecast by the Mortgage Bankers Association, what key factors do you think will have the most significant impact on mortgage rates and availability in the coming year?
Yeah, and I'll kind of frame it up a little bit with what I was talking about in terms of, what are the key drivers of mortgage rates? I think you got to look, where do you think the basis is going to be? Where do you think the 10-year Treasury is going to be? Right now, that's way up, right? I mean, we are knocking on the door of 5%, right? I think I saw it this morning. It was at 4.95 or so. So what's driving that? As I mentioned, I think is inflation, wage growth. Also, because you're looking at a Treasury rate, certainly there's a view on budget deficit and maybe a little bit of kind of government function, like how well are they actually going to be able to kind of finance those deficits? So there's, to me, some underlying pressure on that basis. Sometimes you see, particularly in moments of economic uncertainty, we saw with the events in Israel a couple of weeks ago, you do sometimes get a flight to quality that'll push that rate down, but that's been pretty limited. Right, I think we saw now that we busted back through 4.9. So I kind of see the 10-year Treasury really, and you can look at our forecast too, that's where it is, or maybe could be up a bit, right? Just kind of given the need to kind of finance those deficits. So what about the spread on top of that? I think that was, what I was kind of focused on in the content I prepared today. The drivers there really, I think, are increased volatility. The drivers are lenders need to get return in a small, a smaller origination market. And so I think the things that have kept those spreads wide are likely to be there in some way, but the edge will come off. And I think we do see volatility improving. We do see, that maybe the straight rise in rates kind of levels off. That should make MBS investing a little less volatile. That should let spreads come in. If you look at our mortgage rate forecast, though, and I like, Daniel, the term here, higher for longer. I saw that on one of your slides. That's where we are. I mean, you look at our mortgage rate forecast, we think mortgage rates today, they started the week at 7.5, they're now at 7.6. We'll be lucky to get, high sixes by the end of 24. I think that's basically where we are. Of course, we'll talk about, what that means for affordability. It'll help, but home prices are up and inventory's tight. And so I think, the gains there will be minimal.
Great, thank you. Daniel, back to Texas. The Texas real estate has been known for its resilience. Could you share some insights on how recent national economic trends are impacting the state's housing market, and what unique dynamics should we be aware of in Texas real estate?
Sure. So I tend to think about four big drivers behind, real estate in general. And one of those, the financial dimension, financing is something that's pretty universally impacts across markets. Texans are facing the same, interest rates and access to capital issues that everyone else is. But it's the differences that I called out in my deck, population change, economic activity, productivity of local workers, and in total employment. And that's where Texas has been different. You can argue a lot, and there's been a lot of ink spilled over the concept of a Texas miracle and what did Texas get right, and can you apply that model to other states? And, and the truth is always somewhere kind of in the middle. I mean, there are Texas is the more fiscally conservative state. It's much easier to do development here. We don't have a personal income tax. So those factors are important to corporations and households as they think about opportunities. So those things will continue to benefit Texas. And you maybe say some other states have chosen policies that, put them at a little bit of a disadvantage that drives that migration trend that we've seen. It's been increasing over years. It's not slowing down right now. So those are the things that distinguish Texas. That isn't necessarily, you can certainly see our geography, warm weather, that make our markets a little bit different from other places. But one of the other things that I guess I would call people's attention to just within Texas, the changes. I talked about growth in our big markets. Well, we have 25 metropolitan areas. I did a paper, came out this summer on the center's website that look at industrial. Half of the markets in Texas don't tend to grow that much in and out of business cycles. Those markets that are outside of the Texas Triangle. And if you're on the I-35, if you're an oil market, then you tend to grow no matter what, unless there's a big downturn. So it's really regional changes. And we've seen a little bit of shift in permitting, from the core urban areas. If you look at permitting before and after COVID, now people were moving out to begin with, but maybe COVID accelerated that a little bit. So new markets emerging for where people are wanting to buy and build homes.
Excellent. Okay, thank you. Back to you, Hamilton. Could you provide any insights into how current economic trends might affect housing and mortgage market activity, and what types of loans should lenders expect to see in the market?
Yeah, and I think this goes back to the rate environment we're in and the affordability we're in. When you're saying, hey, as a home buyer, a potential home buyer coming into the market, you've got to spend 33% of your income to buy the median priced home, you end up with a particular type of buyer, right? So the first thing I would say is we're firmly in a purchase market. We've not seen this share of purchase. So we're close to 90% if you look at some of the issuance data. Those refis that are coming in are likely somewhat cash out and maybe even older product that are entering the issuance chain. So I would say firmly a purchase market. And when we look at what's going on with the type of loans that are being originated, particularly in the credit score space, very strong, right? Because these are basically the buyers who can weather this type of affordability pressure. But when you see that, how are folks able to kind of deal with the fact that I said, for instance, home prices up 50%, income certainly not up near that, right? Income's maybe up 15 to 20% over that period in particular areas, and certainly in some areas that's not true. How have households been able to do that? I think partly they've been able to do that by increasing their debt to income ratio. So those are things that we see, for instance, in the data, that those DTIs remain somewhat elevated. So I would say those are the types of loans that we have seen. I think those are the types of loans people might expect. There have been moments, of course, when we've seen rates go up and the market has responded by generating more ARM type product. Haven't really seen that. I mean, I think 2014 was a period we saw it. 2018, we saw it a little bit. Here we saw it ever so slightly. I think late last year, the share of applications we were seeing in the ARM space went up, but that's back down and looks like maybe just slightly above where it was pre-pandemic. One of the things, of course, is tighter lending standards, and I think we may go into that kind of if there are questions. So certainly there's some tight lending standards. I will bring a little bit of research that we put out. We published this earlier in the summer, and we were asking households. So we do a national housing survey once a month where we talk to 1,000 households, and we ask them questions: is it a good time to buy? Is it a good time to sell? And we kind of do a set of sentiment indices that help us understand where households are. We did this particular one about remote work and just trying to get a feel for, hey, has remote work changed fundamentally? Of course, we weren't really asking these questions 10 years ago, but when we look at when we asked it a couple years ago, there seems to be kind of a standard pattern that we've made it into that, looks like about 35% of households are saying they're either remote or hybrid. And that was, from 21 Q3 versus 23 Q1, that really hasn't changed. Why does this matter? What's important about this? People are working remotely more than they were. That looks to be kind of leveled off, and people are dealing, as I mentioned, with affordability pressures. How are they? So we wanted to get a feel for how these two things kind of combine, and got a lot of responses that folks were willing to take a longer commute now. When we looked at this type of question, hey, what is the most important thing to you? What's the most important consideration when you buy a home? Back when we started the survey and asked those questions, in the 2015, 2016 period, it was location. Location is the most important thing to us. Now it is affordability. And you ask households, how do you think about dealing with this affordability? What type of trade-offs are you willing to make? Like I said, willing to take a longer commute, willing to locate more to the suburbs relative to an urban area. That was particularly true for the renter responders that we saw. And I think just generally this idea that thinking about an alternative area than just the one that you've been looking at, I think those are really the kind of responses. I think that's the sentiment that's out there with the potential buyers that the lenders on the call might see.
Okay, good stuff. Thank you very much. Daniel, back to you. With the aforementioned ongoing population increase that you've already talked about here in Texas, how do you see this influencing housing demand, and what opportunities does it present for lenders and real estate professionals in Texas?
So I've been looking a little bit at longer term changes. There's things like the structure of households, and we know from a lot of studies and what we've seen in our own families' lives that the nature of households are different, the mix of types of people that form households. So that's, I think, an important factor that will be influencing the types of products that people want, and that builders are already beginning to think about some of the post-COVID lessons about including more space for home office. And we're seeing something in actually average home sizes. The size of new starts has been coming down for a while, and that's something that happened also way back when interest rates were high again in the 80s, where you saw Texas home prices were growing, and then they start shrinking again, just reflecting it's a more expensive product. People are choosing. As Hamilton mentioned, they were looking for affordability, but they still want to get the biggest house they can pay for, but that's a smaller house these days. So those are factors that I think, even with growing population, you're seeing, well, maybe, I'm wondering, are you going to see an increase in household size? I've had a lot of realtors ask me, are we going to see local governments start changing permitting to allow for new types of housing that will more easily accommodate multiple generations, with a lot of different immigrant groups from Asia, Latin America, Africa. You know, their household structures are different from the way Americans have tended to live. So I think that possible mix of new products, you know, smaller homes, things like that will affect the type of transactions that lenders might be financing in the next few years.
Okay, good. Thank you very much. Hamilton, back to you. So in light of the evolving economic landscape, what advice would you offer to prospective home buyers? And are there any emerging opportunities or challenges they should be aware of?
Yeah, and I'll go back. I think the fundamental, you know, there's two very related issues that any potential home buyer would face. I think, of course, we've talked about affordability, and I can talk a little bit about kind of how they might navigate that. And then this fact that the inventory is very limited right now. You know, usually you look at the market and you say, okay, if you take a kind of a pulse of what type of sales are happening in the market, the vast majority of sales in the national market are existing home sales. So they involve a current homeowner listing their property for sale, selling it, potentially moving to, you know, I think the standard model is first-time home buyer buys a home, sells it, moves up, right? And so somehow releases that stock. So that's 90% of the time, that's what you're dealing with. But 10% of the time, you know, at least this is true over the period, let's say the 2008 to 2020 period, 10% of the time you're dealing with a new home. And we know that new homes, for a lot of reasons, have become more difficult to build. You know, cost certainly has been a part of it. Zoning has certainly been a part of it. So usually, if you're a first-time home buyer, you're firmly focused on existing homes. The problem with existing homes right now is that, you know, if you look at existing homes, that typically on the full market. So if you say in the U.S., how big is that market? Again, I would say 2005 to 2020 period, it's 5.5 million, right? So before the pandemic, 5.5 million units roughly. In the pandemic, there was a shift in preference to housing, right? There was stimulus package. People weren't spending on other places. Millennials had pent up demand. Interest rates were low. We saw a big surge in sorting there, and we saw a big surge in existing homes. Existing homes got as high as 6.5 million units. And so you look at the state of the world today, and I, you know, and you guys have seen the numbers like I have, we're now below 4 million existing sales. That is a very low number. You've got to go back to the great financial crisis to see that number. And basically what it says to us, why aren't people selling their homes? Why aren't they giving, you know, these existing homes a chance for first-time home buyers to go in and then they move in a different part of the market? Number one, the interest rate they have on that property is probably 2.5% or 3%, right? And so to ask an existing homeowner, hey, why don't you give up this 2.5% and 3% interest rate, go into the market. Oh, and by the way, home prices are up 50%. Why don't you buy something else? And why don't you take a 7.5% interest rate? Of course, that's going to limit the market. But the other part of this that I think is missed, that 6.5 million unit number that we saw in the pandemic is really only possible because people have pulled forward their activity. So we're in this kind of lull of a market where a lot of the decisions that we've made in the past, and including interest rates, including sales, are limiting the opportunities for the existing home buyer, so that the first-time home buyer, to come in and participate in the market. That's the doom and gloom. That's the bad news. We have seen a shift in terms of the home builders being able to provide product. So, you know, part of it, existing sales are down, but new home sales are at their long-term average. They're about 700,000 units, and those have now become, instead of the 10% of the market, closer to 15% of the market. I was on a panel with John Burns, real estate folks, a couple weeks ago. Those guys are like big into kind of builders and the data around builders, and they're convinced, it sounds reasonable to me, that the new home builders are increasingly looking to try to serve that first-time home buyer market. So that would be kind of generally, I know that's an affordability question, but you look at the the kind of traditional relationship between first-time home buyer and new home sales, that's changed a bit. The other thing, of course, I would say to anybody who's buying homes, they've got to be flexible and understand interest rate is a variable part of that transaction. I don't think we can expect to see 3% interest rates, but you know, when you get a 7.5% interest rate, there will be opportunities at times, given rate volatility, to refinance. But you know, you've got to make decisions about affordability. And I think, again, that to me, if you look at our survey, if you look at what home buyers are doing, that means locating further out. That means thinking about, you know, other ways of, you know, buying a different size home, buying in a different area in a certain metro. So I think just those general things have to kind of, you've got to be open, because, you know, if you're fixed on like, I'm going to buy a property in this area, inventory is so tight that, you know, that upward pressure on price is really going to be what wins the day.
Yeah, it feels like the builders are sitting pretty right now because, you know, there is such a shortage of supply, and that's got to come from somewhere. And if current homeowners aren't releasing their inventory because they're sitting on that 2.5–3% rate, you know, the builders have good days ahead. Now, I know some of them, builder confidence is a little low right now because rates keep climbing and they're reluctant. But I mean, I think if you're a builder, I think it's a supply issue, and there are people out there that will buy at today's rate. So, and there's all kinds of unique financing tools that can be used for, you know, temporary buy downs or whatever. Builders can help fund the interest rate buy down for the buyer. So I think the builders are in good shape for a while.
Yeah,
personally.
absolutely. Really a source of innovation. I mean, when we look at like the rate buy down that you talk about, and then also this pivot in terms of trying to serve the market, that's been kind of a success story, I think, in the housing market. The other thing I'll say, interest rates are up. They're never up in isolation, right? And like, so one of the things I told you guys that I think is driving interest rates, we think is driving interest rates, is inflation and wage growth and income growth, right? So in some ways, when the market moves up to a new interest rate, there's a moment of kind of paralysis, like we saw at the end of 22, but people adjust to those higher rates. Those higher rates must be linked with other parts of the economy. And so I do think, you know, you look at a 7.5%, there's a bit of sticker shock right now, but if incomes keep up with that, then the buyers will go in and they'll buy at that rate. And, you know, maybe, like I say, rates drop for whatever reason, they can refinance.
Okay, Daniel, another question for you. So the pandemic accelerated work from home, migration trends, et cetera, and it affected the demand for residential real estate in Texas significantly. Do you anticipate any long-term shifts in housing preferences that could impact the mortgage industry?
Yes, I mean, the short answer, and I would piggyback on a couple of things that Hamilton said. He talked about that new home to existing home ratio, and so nationally, you saw historically 10% of sales were new construction, jumped up to 15. Well, you know, in Texas, it's now 20%. So an even higher share of new sales are coming from new construction because of the decline in the existing inventory sales. So I think, I mean, some of the things that we're beginning to pay a little more attention to, I think the discussion we just had about builders is right. You know, builder sentiment was improving a little bit through this year, but it just flipped negative again, you know, in terms of their survey in September. So they are a little worried about the situation. And, you know, inflation, I agree with the inflation argument. You know, we've seen construction materials and labor prices go way up, and then they've stopped increasing for the most part, but we haven't seen a lot of pullback in terms of material costs, you know, so it's still expensive to build, and construction talent, especially in the skilled trades area, is getting a little more expensive to access. And if you're not in one of those booming markets, it's impossible to find anybody to swing a hammer. So again, that's, you know, the smaller metros in Texas are not going to see a lot of new inventory delivered, period. One of the things I'm really interested in, though, is build to rent. We are seeing subdivisions kicked off where, you know, you think about horizontal multifamily. These are detached single-family homes that are built with the intention of renting them. You know, so you have standardization in appliances, some other things to make them cost-effective for the builder, and that's still in its infancy. You know, one analyst I heard comment that build to rent and single-family is about where multifamily was in terms of institutional finance a couple of generations ago. And if we see institutional capital get behind the build to rent concept, I think we could see the floodgates open and a lot of home demand being satisfied by rentals rather than purchases. Because go back to the psychology that we've been talking about. People want that detached home. They want the space, whether it's for kids or whatever. But more and more people, especially younger people, are willing to think about products as a service rather than owning that product. So I think that could be a major trend that mortgage lenders would want to follow. I talked about slowing Texas migration, which is not going to be a big deal. The changes in household structure, you know, nationally we saw the number of married households actually fall Now that's an estimate from 2020 to 2022 estimate. There's fewer people that are married. That used to be your best predictor of buying a home, is if you were married. And so we know those marrieds are a continuing smaller share of all households, but they've actually started going down now if that survey data is right. So things like that, I think, will be changing the housing market in the next 5 to 10 years, regardless what happens to interest rates.
Great, thank you for that. Hamilton, back to you. So the housing market has been experiencing fluctuations in recent years. So how do you foresee these changes influencing the mortgage industry, and importantly to all the lenders on this call, how will this affect the lenders?
Yeah, and as we think about the lenders, one of the things that I was mentioning, that housing survey that we put out monthly, we also do a survey of loan officers and kind of generally how people are perceiving some of the challenges, the higher rates, the home prices. We don't do that as frequently, but we did put out a survey earlier. So this is our mortgage lender sentiment survey, really kind of asking folks, how are they thinking about priorities this year? How are they thinking about some of the challenges? We asked, and this won't surprise anyone on the call, especially at what we've been talking about, what are the biggest concerns or challenges that are facing the lenders? And this was earlier this year: housing supply, mortgage rate increases, household liquidity, household debt. Those were things that we saw them kind of respond to. Of course, I think then the biggest challenge, of course, when you're dealing with these types of items, rates are high, inventory is limited, origination volumes are low. And as you saw, that really limits kind of what can be done with pricing in terms of spreads. Spreads really have to remain wide to kind of cover some of the costs as they relate to these origination volumes. So asking lenders what are the biggest priorities, so that was one of the other questions we asked them. What we saw this time relative to what we'd seen a couple years ago: bigger focus on cost cutting, bigger focus on streamlining, but still pretty healthy focus on workforce development and also investment in consumer facing technologies. But those were kind of down from where they were pre-pandemic. In general, I would say, so when we other questions that we ask, and we typically ask these usually when we do these types of surveys, what's going on with credit standards? Like, how are we thinking about credit standards? You can look at the responses that we've published. You can look at the responses of what the Fed Senior Loan Officer Survey publishes. One of the real challenges for households in this environment, it is, and we ask the households, hey, is it difficult to get a mortgage? We're at all-time highs on the survey of folks saying it's difficult to get a mortgage. It's hard to disentangle whether they mean my mortgage rate is really high that I might get, or credit standards have tightened. But certainly I would say, we ask the lenders and they say, yes, absolutely, credit is tighter. We've tightened credit, and I think that, of course, is, partly to do with the tighter monetary policy. And so when we kind of say, well, if you're a lender and you look at where do credit standards matter most, what's going on with the most marginal of buyers that are coming to shop, really the limit right now is debt to income, right? I mean, like I say, if you look at a national level, the relationship between what's happening with home prices and what's happening with interest rates, those have grown much faster than what has happened with the underlying income. Part of that you can deal with because you get a selection effect and you get a stronger buyer come through the door, but there are limits to that. And I think that really is the challenge: is how can you look at a buyer who's credit worthy and kind of dealing with pressures of affordability. You're going to see it through the DTI, and just thinking, like I say, we look through the data and we see it. And I think the way that households have been able to deal with it is by choosing an alternative property or location. I think that's kind of the main challenge, of course, with lenders on the other side, kind of thinking through that.
Yeah, I think also too, I saw something a day or two ago that credit card debt is now up over $1 trillion outstanding. And so with interest rates being as high as they are on credit cards, that's going to impact affordability as well, as far as what they can qualify for. So you've got high home prices, high interest rates. So that affects, what we used to call the front ratio. And then you have all the other debt that affects the back ratio. And, you've got student loans now no longer being forgiven, things like that. So there's a lot in play as to the affordability and how much people can qualify for.
Yeah, and I don't know what type of rabbit hole we want to go down, but because we think about these payment shocks all the time. Student loans is one of them, as we all know on this call. Property taxes is one of them. And then insurance, property insurance, particularly in some of these markets where we've seen exit of insurance providers. I think all of those things, are, whether they're in our traditional DTI metrics or not, or whether they're in the mindset of the household or not, those are things that, can at times be sticker shock.
Yeah, the old PITI. The PI is growing because of the interest rate for sure, and the amount of money you have to borrow just to buy a house. And then now T&I are growing as well because of the values increasing and therefore taxes going up. And obviously insurance is skyrocketing as well, especially here in Texas.
Yeah.
Great, thank you. Daniel, one more question. As Texas continues to attract businesses and residents, what do you see as the key challenges and opportunities for mortgage lenders operating in the state? And how can they adapt to effectively serve the needs of the Texas market?
Well, I think most of what I would say we probably already covered in some of the other segments. Texas is going to face a lot of these issues. As Hamilton just mentioned, we talked a little bit about insurance. We talked a little bit about how that maybe environmental risk is driving that. So insurance is something that more and more brokers, when I talk to, whether it's on not as much on the commercial side, but some on the commercial side. And how is that going to affect? We've got a piece coming out in our magazine this fall, just taking a look at, are we going to see insurance companies being a bigger obstacle to mortgage transactions? If they're only willing to do replacement costs on these much more expensive homes, then how that's a barrier to making that loan. So I think that's something that lenders need to pay attention to, and insurance is something that we don't have a lot of. It's not an activist area in terms of policy, but we may need to start thinking about that in terms of bigger pools. I like to think about markets can deal with scarcity, and one of the things that if you grow up in Texas, one of the things that's scarce is stable climate. We're right in the middle of the wet and the dry Sun Belt, and we get a lot of storms in Texas. The weather, we joke about it, but it's something that it's a little bit different about Texas than other places. But our communities, I think, to deal with some of those risks, we're better at doing infrastructure than some places. If you go back in the Southeast, where they don't face dramatic changes in rainfall, you don't see the level of storm infrastructure and detention ponds and other things that we've already built into a lot of our cities. So I think going forward, the risk side is you're going to see even more public investment. And beyond that, again, I think the changes in financing, if we see dramatically fewer traditional families buying homes, does that have an impact on as mentioned, credit, and evaluating credit when people aren't bound together, by that a marriage or something along those lines. So it's just a lot of things that are in flux long term, but I think the more important issues right now, obviously, are just the supply and demand imbalances. And then are we going to see that shift to something like the build-to-rent, which could have a big impact? I'm not real optimistic about our short-term multifamily. Some places like Austin, northern Dallas areas are seeing a lot of deliveries, but we need a lot of multifamily in some other parts of the markets, and I'm not seeing builders jump on that yet. So that's going to make it even harder to house people.
Great, thank you. We do have a few minutes left, and we have a question in the chat, and I think it's probably more so for Daniel than for Hamilton. How do you see the regional banking crisis playing out in Texas, and how is this impacting mortgage originations? So thank you for submitting that question.
My short answer is I think, if regional banks had been making investments, in Texas real estate, they should be in a little bit better position than regional banks in other states. But I do think we're going to see a few more of these regional banks run into problems. And I don't think it's going to be a train wreck. I think it's more of a little glacial kind of, occasionally some hits here and there. But the Texas economy is not the way it was, fortunately, back in the oil bust in the 80s. If you were around then, where almost every single bank in Texas went down because of their heavy investment in what were a lot of bubbles in commercial real estate and housing across the state. we've seen the fundamentals, the population, the job growth be a lot stronger, and it's more diverse. So Texas's economy is not subject to just oil and gas the way it was then. So I think Texas regional should do better, than the national average.
Great, thank you. I don't see any more questions in the chat at the moment. I'll do a follow-up question of my own to you, Daniel, pertaining to Texas. You mentioned about the in-migration that we've experienced and the population growth, more so during COVID than any other time in recent history. So a family moves here during COVID, they bring 2, 3, 4.5, whatever kids with them, and they settle here, and the kids grow up in the schools here in Texas, and they end up liking it here. So then they decide to live in Texas as adults. So that one household that we created will turn into 2, 3, maybe 4 households 20 years from now. How are we prepared for that? I mean, if we're already looking at a shortage of housing right now, what does it look like 20 years from now for those of us in the housing finance business and real estate and home building?
Well, I mean, hopefully, again, I'm pretty optimistic about market's ability to supply housing, but I think, we're probably, in Texas, we're going to have to think differently about some things. We've done a good job about infrastructure investment. You think about water, power, those things that we need to keep adding to, road infrastructure. If we don't keep adding on those, then we're not going to be able to accommodate growth, or people will continue to come and our quality of life will go down. I use California as a cautionary tale. California made massive investments in infrastructure in the 30s, 40s, 50s in terms of water, roads. They built the world's best higher education system. And then they essentially stopped, right? And people continued to flood into California because of the opportunity there, because of the quality of life. And then now it's a state that seems to have lost its will to invest in itself, to accommodate that growth and to give opportunity for people across income spectrum. So Texas has prided itself on accommodating different types of people. Our job growth is across blue collar, white collar, all these industries, but we're going to have to keep investing, or we're just not going to be able to keep up and enjoy then that migration will trickle, it'll fade away, because it won't be as nice a place relative to where they came from, the way it used to be.
Okay, thank you. Well, we've only got 3 minutes left. I'll give each of you a chance. Hamilton, Daniel, any parting words of wisdom to the group watching today?
I'll just say I agree with Daniel about this. With the interest rates being higher, right, we haven't really seen the rate above 7.5% long enough to understand where the disruption can happen. And so, it may or may not be on the bank's balance sheets like it was, earlier this year. I would kind of look out just generally for macroeconomic risks in a higher rate environment, right? And I think one of the things we're looking at is whether businesses who were able to refinance some of their debt kind of early in the pandemic are starting to hit a point where they need to kind of roll their debt over, and what happens there and what segments of the economy are affected. I think that for us is a main risk, and one of the reasons why we still have this recession call in our forecast.
No, like I said, it's spooky when so many of the economists start agreeing with each other. So just be prudent. Run your business, manage your operation in a way that makes sense, and it might be a good time to be conservative and think about how you break from the pack a little bit later on. So.
Good, great. Thank you both so much for your time today and sharing your knowledge with us. And to all the attendees, thanks for spending time with us today as well. The TMBA continues to work on bringing you great webinars like this one. So please check out the homepage at texasmba.org for the upcoming schedule, and watch for those emails from TMBA reminding you to register. Thanks again, everybody, and have a great day.
Thank you.
Bye-bye.
Bye.